Hey guys, welcome. Welcome to episode 11 of Tuesday Night Live. And we got election night. So we'll be kind of curious to see how many of you peel away tonight from the watching the polls to actually tune in and watch us here. And if not, certainly this recording will be available for you later. And if you're watching it post-production, that's okay too. Guys, tonight we're talking about mortgage forbearance. We're going to go over a lot of the updates. The forbearance program is going to be coming to an end at the end of December, and we don't know whether it'll be extended or not. We're also going to cover the risks at buying at the top of the housing market, and we really are at the top of the housing market right now. We're going to talk about the potential for foreclosures due to a lot of different factors. Guys, we're in a pandemic. This pandemic has raved havoc over so many businesses and so many people, and jobs have been lost, and salaries have been chopped and cut. And a lot of people that have been buying over the last several years are buying because they, based on the income that they were making. So if there's two people, providing the income to make the mortgage payment, and somebody loses their job, and hey, that's why they started this forbearance program. And guys, I'm Todd Sachs. I'm the broker and founder of Sachs Realty. We're a boutique brokerage here in Maryland. But the exciting thing is we help people buy and sell all over the country. We've got an amazing broker referral network program. So if you guys don't have agents and you'd like some help, get pointed in the right direction, you can reach out to me. All my contact information will be within the content of wherever you're watching and listening to this episode. And so we're real estate wherever you guys are, okay? And so tonight, I'm really excited. We're going all the way to the West Coast, and that's a different time zone. So no matter where you're watching right now, we're on the East Coast, and we've gone all the way to California, and I'm honored that I'm with Matt Gouget. Matt goes by Matt, the mortgage guy, and he's an independent mortgage broker, and he's going to help us with some great information. We're going to dive right in. And guys, what's mortgage forbearance? I mean, a lot of talk about mortgage forbearance, and if you're not in mortgage forbearance, basically, according to USA.gov, and we're going to put a lot of links in our show notes. Those affected directly by COVID-19 are eligible for up to 12 months of mortgage forbearance. And they kind of chop that up in a couple different phases. And was 3 months, then it went to 6 months, and now you can get up to 12 months. And basically, it's a program that's out there that for people that are having trouble making their mortgage payments because of the coronavirus pandemic. And your loan servicer must, work with you to defer or reduce your payments for 6 months. And if you contact your loan service provider, you need to do that to make arrangements. And there's another 6 months of option out there for you at your request. And anyway, they're going to make up also options for you how you can make up those deferred payments. And this is all part of the CARES Act, which a couple months back, and we had a video, we'll put that in the show notes as well, that where we talked about it actually being extended to December 31st. So anyway, without further ado, I'd like to bring in Matt Gouget. And Matt, tell everybody a little bit about you.
Cool. Yeah, thanks for reaching out, Todd. Happy to be here. Happy to be chatting with you and your audience, whoever's going to peel away from election night polls and watch this in the future. I'm an independent mortgage broker in Sacramento, California, and I've been in the mortgage industry for about 7 years. And I think my claim to fame has just been keeping it real with folks and shooting straight and just giving super honest, easy to understand feedback to folks, whether that's good news, bad news, whatever it is, just shooting straight with them.
Yeah, and you have a YouTube channel too where you educate a lot through your videos. So we'll put the links to that and also in the show notes, and check Matt out. He does exactly what we do, and that, I mean, we believe in serving and giving as much valuable content and information to help you, the consumer or agent or investor, to make very informed decisions and be a good current resource. So Matt, for those that, I kind of gave a brief overview. For those that really aren't familiar with the mortgage forbearance program, can you quickly kind of dive into, some more of the facts?
Sure. And mortgage forbearance in its simplest form is you reach out to whoever's servicing your mortgage, whoever you're paying your mortgage payment to, and you're having trouble making your payment. Can I put my payments on pause, not pay for 3 months? And when the CARES Act was initially passed, most servicers, they all did it different, but most of them were saying, you tell us that you're having trouble, we'll put you in forbearance for 3 months. And then if you want to extend it, you can extend it 3 more months. Like you said, some did 6 months with an extension. They've all kind of come together and said 1 year is going to be the max, but they're broken into 3 or 6 month segments. And it's basically saying you get to take a break from making your mortgage payment. And I'd love to say, Todd, that it's only if you've been truly affected and someone's lost their job. But really, they made it to where somebody could just click, I've been affected. There was big banks that were automatically putting people in forbearance without even asking them. You had to opt to get out of it. And so we'll dig more into it, the numbers and whatnot with forbearance. But part of me feels like these almost 3 million people that are in forbearance, some of them may not necessarily need it. But that's the quick and dirty explanation on what it is. You're just taking a break from your payments. And then coming out of forbearance, which we're starting to see now because some people entered in April, they did it for 3 months and then extended it. In October, a lot of data came out because people were now exiting forbearance. And this stuff's been evolving and changing on how they're going to handle it. They're giving folks options, as they should. You can make up your payments over the next 12 months and you owe us, you missed 6 payments for a total of $9,000. So you're going to pay us $770 a month over the next 12 months and make it up, or we're going to lump it and put it on the back of your mortgage, which is probably the most common. Because if people are having trouble making their payment, let's be honest, they don't have extra money over the next 12 months. They certainly don't have $9,000 to pay it all in one lump sum. So for the vast majority of them, they're able to, and they're opting for, throwing that $9,000 on the back of their loan. It almost sits on there like a silent second.
Now, when they first started this forbearance program, they weren't they requiring it at the end of that 3 month period, that big lump sum, and then they made the change to not do that, right? I mean, if people didn't have their mortgage payment, chances are in 3 months they're not going to have 3 months of mortgage payments.
Exactly, and it was scary. I put out a bunch of content through my YouTube channel and through just my network of folks that I'm communicating to, and I said, please be careful, beware, because kicking the can down the road, hoping that you're going to be in a better position in 3 months and have this big lump sum to pay, is a really scary proposition. And so I understand a lot of people needed it, and so I'm happy that they made those changes. They said, okay, let's be realistic. People aren't going to come up with $5,000 and come current. And so they did make those changes, I think, before anybody came out. And some people, honestly, they were in a position where they weren't sure. I don't know about my job, my wife's job. After 3 months, they just put those payments to the side. That's the responsible thing to do, and you hope that everyone would do that. And after they had some job security, found out they weren't going to be laid off, they took those payments. They said, okay, I'll pay it and I'll make it current. And so some people could, but a vast majority who were laid off or furloughed or just lost their job. I mean, imagine all the service industry folks. You worked for an airline or you worked for a restaurant. Those people just couldn't pay.
Yeah, sure. I mean, hospitality was crushed. And you think a lot of states were shut down, even contractors couldn't work. So, I know people directly, in Maryland here that were interior contractors, and basically they were shut down, not because they had to. The governor kept contracting and home service providers as critical workforce, but people didn't want them in their homes. So, I have a brother-in-law that does high-end home renovations, and, he works for a lot of doctors, and they basically, you didn't want to be in their home, but, they were quarantining. Some of them were staying in the basement. Some were, splitting the floors. And they basically said, hey, look, I'm sorry, but, we have to put these projects on hold. So a lot of people were affected. One of the questions that I get a lot, and we're going to throw up a slide here in a minute, and for those of you who are listening, through audio, we're going to explain it for you. But it has a lot of great information on it. But Matt, people really want to know, does it affect their credit adversely when they are in forbearance?
I'm happy to report that they've made good on this promise. The promise was always it won't hurt your credit. I think some of the verbiage was you won't even be able to see it on your credit, which was wrong. It shows up and it shows that it's currently in forbearance. But as far as a negative impact, I haven't seen it. And the
Okay.
good news is now we've got the data of people who were April, May, June forbearance. They've come out of forbearance. They've been able to refinance. And so we've seen that, they've come out unscathed and credit wasn't hurt. But for a good period of time, lenders were trying to still figure out, what are we going to do? Can we refinance these people? And I didn't blame, as a broker, I've got access to 60 different lenders. I didn't blame a lender that said, hey, listen, this person just said they couldn't pay their mortgage. What makes us want to reach out and lend to those folks? And so at first, some lenders said, I want them to not only remove themselves from the forbearance and make good on what's due, but I want them to make 3 payments. Then I'll refinance them. And that's changed. And a lot of lenders now will, as long as you're current, they'll refinance you, or let's get current through your refinance. But there was a process where things were changing every day and lenders were figuring out how to do it and whatnot. And so it's been constantly evolving. And now we're starting to get some more data and people out of it to where, we got some real life examples.
Yeah. Well, let's go ahead and pop that slide up. And again, for those of you that are watching along or listening along on audio, according to the Maryland Bankers Association, and Matt, you can correct me if I'm wrong, but I think they post this thing almost every week, and we'll put the link. Anybody can go on and check it out. But according to the Mortgage Bankers Association, the latest forbearance and call volume survey revealed that the total number of loans now in forbearance decreased by 7 basis points, which to me doesn't mean a whole lot. It goes from 5.9% of servicer portfolio volume in the week to 5.83% as of October 25th. And this was just posted yesterday, by the way, November 2nd. According to MBA's estimate, 2.9 million homeowners are in forbearance plans. And as Matt had said, maybe it's not all because they're affected by COVID. There could be other reasons. Maybe they were delinquent, and I don't even know. Matt can clean it up as whether you could go on it if you were delinquent prior to COVID. But with Mike Fratantoni reported, and this is on the Mortgage Bankers Association website, with more borrowers exiting forbearance in the prior week, and to me, it's not that many less. The share of loans in forbearance declined across all loan types, and almost half of forbearance exits to date have been from borrowers who remained current while in forbearance, or who were reinstated by paying back past due amounts. And then MBA's senior vice president and chief economist said that the share, and that's Mike Fratantoni, said the share of loans in forbearance has returned to levels last seen in early April, but still remain remarkably high. Further improvements will require ongoing recovery in the job market, which is the big thing, guys. And we're going to talk about the jobs and how these people are going to come back and if they can come back. But as well as additional fiscal stimulus. So the improvements here are going to require jobs being strong and additional fiscal stimulus, checks, money cut, printed and cut and sent to people in order for them to, cure their default, essentially. I mean, you can call it a forbearance program, but essentially it's a default. You can't make your payment. Matt, these numbers, are these alarming?
I think so. The 3 million number sounds huge. And when they talk about being less than 3 million for the first time since April, back in April and May, when we just had tons of forbearance. Everybody went into forbearance. Like I said, some big banks automatically threw people in forbearance. That number was up to 5 million. And so I think while 3 million is a big number, it's a big decrease from the 5 million we saw 5 months ago. But the thing that scares me, like you said, in order to come out of it, we're going to need some good times ahead. And the only thing I'm certain about is that we've got a lot of uncertainty. You talked about out in Maryland, certain things being locked down. I'm in California, and we don't have long enough on this podcast to talk about California and our governor and how lockdown's been here, and I'll skip that. But that's something that I think, to me, is alarming. If we had an end date, a back to work date, people are going to recover and things are going to chug along, it'd be different. But the problem with it is we don't know when we're going to see light in this tunnel we're in. And for whatever percentage of those 3 million that truly need the help, I'm not sure if and when they're going to get it. You talked about the industries that were super impacted, and there's businesses that are shut down to never reopen. What are those folks going to do if they can't, re-enter the workforce? So it's scary. And I think if lockdowns continue, you have to extend this program. And the folks that truly need it, that's what's going to get weeded out. I think that's already what's happened. That 5 million down to 3 million was, some people entered it, they were uncertain. Their job's secure. They realized, what? My wife works for the state and my job's going to be fine and my company's going to be able to continue to operate. So we're out of forbearance, we make it good, or we throw it in the end, whatever it is. But now we're getting down to the people that truly need it. They're out of work, and it's an interesting time. I mean, there's so many different things to think about, because all these people are in a position where it's really hard for them to make their mortgage payment. Home values are all-time high. So they're not going to walk away. The last crash was something totally different, where they said, well, I owe $390,000 on my house and it's only worth $250. I'm walking away. Now my house is worth $500. I owe $350, but I can't find work to be able to pay this mortgage payment. What do I do? And a lot of interesting stuff, man.
Yeah, for sure. Well, we do have another slide. Let's go ahead and pull that up on forbearance. So more along the lines of some of these statistics, and these are current by stage. Okay, so we're talking about the 3 million loans that are in forbearance programs. 23.95% of total loans in forbearance are in the initial forbearance plan stage, while 74.49% are in the forbearance extension. Can you kind of explain that a little bit?
Sure. I mean, that's saying that 1 in 4 roughly are initial forbearance stage. So they haven't asked for it yet, but they've decided 6 months into this lockdown that, oh crap, there's an issue, and I'm going to go ahead and take advantage of something that's available to me. And I say take advantage in a nice way. People that need it, need it. And I agree with the fact that you take forbearance. 6 months ago when it first came out, I just warned people and I said, if you don't need it, please don't take it. But 1 in 4 people decided they're going to apply for forbearance and enter forbearance. And then it looks like 3 out of 4 people who are currently in forbearance, of those, so that's 2.25 million of the 3 million, are folks who are in a forbearance extension. So they either
Which means they went 3 months to 6 months, or 6 months to 12 months.
Right. And some of them might be, re-up in October for the next 6 months. And I think that the original plan, where it was a max of 12 months, might have to be extended if people need it. Otherwise, we're going to have a flood of foreclosures, because even with forbearance being available to people, I've seen some delinquency stats that are relatively alarming, where this is available for people, but we still got people that are 90 and 120 days late.
Yeah, well, we're about to talk about that a little bit further down on this slide. So the remaining 1.56% are in forbearance reentries. I guess they had, maybe a 3-month forbearance, maybe came out of it and requested to go back in. And then total weekly forbearance requests as a percentage of servicing portfolio volume decreased relative to the week prior. You know, I guess, you know, we are seeing a very small percentage of forbearance exits. But let's look at these stats. So October 25th, 2020, 32% represented borrowers who continued to make their monthly payments during their forbearance period. 23.8% resulted in a loan deferred or deferral partial claim. Matt, we're going to have to get you to clean these up. 17.2% resulted in reinstatements, in which past due amounts are paid back when exiting forbearance. 10.9% represented borrowers who did not make it. You did not make all of their monthly payments and exited forbearance without a loss mitigation plan in place yet. 7.2% resulted in loans paid off through either a refinance or selling the home, which is encouraging. And 6.9% resulted in loan modification. Kind of break that down for us.
Sure. And you know, it's going to be different for each servicer, and they've all kind of come up with their own set of rules. I continue to see new stuff every day. I saw something today where we start to do a refinance for somebody who's got an FHA loan. We're going to refinance them into a conventional loan, and we got a HUD lien on the property. And my processor sees a HUD lien and says, well, I looked at that 12,132 number, and I divided it by 3, and that was their monthly payments. That looks a lot like they were in forbearance. So, and she was right. They took a 3-month forbearance, and FHA's way to resolve that was they said, we're going to put a lien on there, and we're just going to throw a second mortgage behind your first. You owe us that 12,000 whenever you refinance or whenever you sell the home. And so, you know, that's one result. And I think this is good news to see that 1 in 3 are people that entered forbearance, or, like I said earlier, were put in forbearance and didn't even know it, and we're still making their payment. So those folks are in the clear. 1 in 3 people are basically saying they don't need it by their continuing to pay. 1 in 4, it looks like, partial claim or a loan deferral. That to me is those folks that are putting that loan balance at the end of their loan. They're just deferring it. And 17% of folks are reinstating and paying those past due amounts. Like I stated earlier, there's some people that put that money to the side just to be safe, just to say, let's play it safe for now and put that money to the side. And little bit scary to see that over 10% didn't make all their monthly payments and exited forbearance without a loss mitigation plan. This is a good place to just remind folks, if you're in forbearance, you've got to communicate with your servicer. These servicers, while I'm sure they're dealing with a lot of volume and a lot of people who need help and need questions answered, you've got to be your own advocate and make sure that you're speaking with them and making sure your credit's not going to be damaged. And a 30-day, 60-day, 90-day late on a mortgage is really detrimental to your credit. So make sure that you know exactly what's going on. They can and will send something to you in writing. And I've talked to clients who have exited forbearance, and they sign something agreeing that I know I owe these 3 months, and it's going to be placed on the back of my loan in second position and whatnot. So that's something that people need to make sure that they're on top of. If you're not going to be your own advocate, don't depend on a servicer that's got millions of people in forbearance to be able to keep up with everybody. So then
Matt,
you have people.
Oh, go ahead. Go ahead.
No, I was just going to finish up with the few we had left on the slide, and basically saying it looks like some people sold their home. And like I said, if you have a home that's worth $500 and you owe $350 and you're in forbearance and you're like, I don't know what the heck I'm going to do. Some people sell it. They take that $100,000 and they put it in the bank and they go rent something, and can't say I blame them.
Yeah, and we're definitely going to talk about that in a little while, because we're going to discuss, what kind of percentages we think that people that will try and sell. And, it is a little different situation, has some similarities as a housing crisis in 08, but it is different in some ways. That, like you said, the prices are very high and inventory short. We're going to look at that. So I hope that as a result, people do get out from underneath of these mortgages when their situations have changed, and that these forbearance programs that maybe will allow them some time to do that based on, what happens. Do you think they're going to extend this forbearance program past the end of the year?
I think so. I think they should. If the world was open and we weren't still in a pandemic with lockdowns going on, everyone's back to work, then it should be ended. But while people are still out of work, suffering, can't pay, you have to. I mean, there's so many different things. I'm not a politician, but on election night, we can pretend like we are. People need help, man. I mean,
Yeah.
I'm still surprised that there's not some sort of rental assistance and stuff to help. You got
crushing all these landlords,
small landlords that are just really being crushed.
Yeah, you're right about that. That's a different topic altogether. So when we say that the forbearance program is ending at the end of this year, that's the actual application date to apply, right? That's to
Correct.
be able to say, I'm in trouble. So we may see a big influx of people that are, seeing this date coming. Do you predict that there will be, over the next month and a half, do you think there's going to be a lot more people saying, hey, we have to jump now before we know that there may not be an extension?
Yeah, I think so. I think naturally, the numbers show that not a lot of folks are, I guess 1 in 4 are basically new forbearance applications or whatever you want to call it. But as people find out that they can't get back to work, or their state, wherever they're at, is limiting whatever type of work they do, then those in need certainly can and will apply for it. So I think that would be something to look out for in December.
Yeah. And then I guess, do you think that they're going to extend this past 12 months that you can actually get loan forgiveness or forbearance where they put that, loan amount that you're not making on the tail end of the loan? You think they'll go beyond 12 months?
Yeah, I think it's the same sentiment where you should. And if somebody entered it last March and they're going to exit it next March, depending on where things are. I guess it all depends on where the economy's at and where unemployment's at, and if people are able to do it in a way where it's not going to be crushing to millions of people.
Yeah, and but I have to say, I mean, as somebody being in the real estate business, I mean, how can somebody stay in their house for over a year and not pay? I mean, it's got to be, you look at it and say, what's going to happen to these servicers, the banks, the financial industry? I mean, we're going to need to print money in order to make that happen, and more money, and we know more debt, and that's a whole host of other problems. But I think the word that needs to get out there is, hey guys, if you're not paying your mortgage, you can't pay it past a 6 or so month period of time, it's probably a good idea to start, talking about or thinking about selling and reducing the amount of debt that you owe, especially if you have equity in your house. So one of the things, and you kind of touched on this, people refinancing. I mean, guys, I understand. I mean, here in our home state of Maryland, and I know this is a problem across the country. I mean, there are certain people that sort of been winners and losers in this, financial, devastation that we're seeing some go through. And because, based on what business you're in and what you pick for your livelihood, you could just be shut down. I mean, I know caterers that, are out of business. I know, musicians and, people that are in hospitality that are basically shut down. I mean, I get it. We have to be realistic and say, are they coming back, and are you, able to do something else to make money? And a lot of these people are, they're homeowners, and they're in these forbearance programs. Are you able to refinance? You had said that some of these, these lenders that you have access to, some of them are saying, hey, look, we want 3 months of payments and we want them to come out of forbearance. Are there options out there for people right now that are in forbearance to take advantage? They're at a 4.5%, loan or 5% loan, and we're looking at 2.25% on a refi yesterday. I think I saw, are people able to take advantage of those lower interest rates, which would in turn help them? I mean, when you're reducing your mortgage by a couple points potentially, that's a lot of money in savings. So what advice do you have for those people?
Well, my first piece of advice is don't believe everything you read, Todd. You see a
Okay.
2.25 advertised, that's got a couple points of cost attached to it. So you'll get a loan estimate that'll have $9,000 in points to be paid for that 2.25. But still, historic lows, sub 3%. To answer your question about the vast majority of lenders just don't want you to be behind. So if you're in forbearance and you're 2 months in, your mortgage statement is going to show you've got two payments that you're behind on. So they're going to ask you, or me as the broker is going to say, hey, Todd, I need you to call your servicer, ask them to take you out of forbearance. You pay them back that $4,200 you owe for 2 months missed, or if you've got enough equity, we kind of roll that in and pay back that past due amount. It's almost like it's a separate lien. And the vast majority of lenders are going to allow you to do that. And like you said, if you have a $400,000 loan at 4.5%, and we take that thing down to 275, you might save $500 a month, and that can certainly help if you're looking at your financial situation and, I'm still working, but I've got limited hours and my wife, lost her job, but she's doing something else on the side. Okay. Well, like you said, there comes a point when people have to put a plan together and say, I'm going to make this work, or I've got to change course.
Right.
Refinance is certainly a way to improve the situation.
And I think you said a really important point. I mean, we know we're not getting out of this anytime in the short term. I mean, there are a lot of people, they think this pandemic, I mean, we're so divided, and how we should handle it, and whether we should wear masks and not wear masks, and that we're not going to get caught up in the political side. We know that there is a major issue still at hand where, even coming up with a vaccine on this thing, if it happens this year, I mean, it's going to be testing, getting it out, whether it works, all this stuff, and we have to convince the consumer that they're ready to go out and shop, because you can open these places up to full capacity. But if a lot of the people aren't prepared to go out, the businesses aren't necessarily going to turn instantly profitable. Many of them were struggling before they even got into this pandemic. And, so, definitely look for your options. You guys, if you're listening to this and, this is something that you need help with, reach out to us. We can help point you in the right direction, and at least get you the facts that you need to know. Last question before we really get into talking about the prices of houses and where people are buying and whether people should be buying, which is a big topic that we're going to, really stir it up a little bit here. What is the long-term effect of these forbearance programs on the servicers? And for a lot of you guys, I mean, Matt, tell people what a servicer is. And and they have to carry a lot of this debt, right? I mean,
Right.
there's still taxes coming in on properties. When you think, guys, that you're not paying your mortgage for 6 months, there has to be a tax payment made, right? I mean, they need to make sure that you're keeping the insurance up on the home. So tell us a little bit about what a servicer does and some of this long-term impact that could affect them.
Right. So a mortgage, an independent wholesale broker. We'll take United Wholesale Mortgage out in Michigan. They're going to do over $200 billion this year. They do a lot of loans. They can't service $200 billion worth of loans they write. So they package it up. They take $100 million in loans and they sell it to Todd Servicing Center out in Maryland. So you're taking that $100 million in loans and you're collecting the payments, but you're selling mortgage bonds, and you've got to keep those mortgage bond holders paid. I'm going to try to keep it simple and not be super complicated. But one good thing, Todd, is that when these servicers were scared to death, like you said, we're not getting paid, but we're property taxes, homeowners insurance, and we're also making sure the bond holders are getting paid. They were gonna be wiped out. Any small to mid-sized servicer was just going to be totally crushed. The FHFA stepped in, and I don't know when this was. It was the middle of the year, and they said, they're only going to be on the hook to their bondholders for 4 months worth of payments. They were going to be wiped out. Any small to mid-sized servicer was just going to be totally crushed. The FHFA stepped in, and I don't know when this was. It was the middle of the year, and they said they're only going to be on the hook to their bondholders for 4 months worth of payments. So with that, they kind of sucks for the servicer to have to shell out 4 months worth of payments to their bondholders while they're not getting paid the mortgage payments. But at least they know what they're dealing with. And so with that in mind, if somebody does 6-month, 9-month, 12-month forbearance, the losses or the liability for the servicer is limited at that 4 months. And my thought is, if it does get extended to say 18 months and the servicer's only on the hook for 4 months, it's going to be hard for them. But it's not going to be something that if they wouldn't have put that cap in place, servicers would have gone out of business. And it's been interesting in the mortgage secondary market, which really I'm on the front lines originating mortgages. I'm not dealing with that a lot, but it's been interesting to see that whole dynamic with mortgage servicing and the wholesale lenders' relationship with them and liquidity issues. And it's been a wild year in mortgage. A quick stat for you too. I just saw something about I think it'll be the first year that over 4 trillion in mortgages are originated, and the Q4 numbers are going to be even bigger than Q3. Tying that into forbearance, it's probably a reason why a lot of people are coming out of forbearance, because they look at it and they go, well, I could take a few more months off and not pay my mortgage payment, but why don't I hop out, refinance, and save myself $400 a month for the rest of my mortgage?
Yeah, definitely. Well, it'll be interesting to see. I guess, time will tell on the extension, whether they do extend the forbearance programs. Let's talk a little bit about buying at the top, because guys, here in Maryland, and I know, Matt, you and I have spoken too. I mean, we share similar markets where you are in Sacramento area, where the median price house and so forth is kind of the same. We have counties that surround. We serve 9 primary markets here in Maryland. In the Baltimore City being one of those, and then the counties that surround Baltimore. And we're seeing, top prices for things. We're seeing, sort of like a resemblance of how it was in 2006, the craziness that's going on. And, what's more alarming and more concerning is that, people don't have money. I mean, for the most part, when we're looking at, I think nationwide, I mean, a lot of statistics point to, people certainly have less than $5,000 in the bank, and we're talking about, home buyers. So, they're buying in these programs that with 3%, as little as 3% down, they're able to ask for seller concessions, sellers to pay a percentage of your down payment and closing costs. And as a result, they don't have the cash. And what we're seeing, which is even more alarming to me as a real estate broker, is I'm actually seeing where people are going in because the inventory is so short. We're going to look at those numbers nationwide, just posted by NAR, National Association of Realtors. What we're seeing is that, a lot of the people are buying these with very little contingencies. And some of them, in fact, I mean, there are certain loans that require, inspections, especially these government-backed loans that require safety inspections, on these houses. But for the most part, we're seeing where a lot of these things are getting waived. And people are buying things, the inspection companies are telling them that their heating and air systems are near end of life, but they're working. And or that the roof is getting an end of life, but it's it's not raining inside, and they're saying that's okay. We want it anyway. We'll buy it, and that is a real concern, because as we know, what happens is when people lose their jobs, people get laid off, or people actually have a job, salary correction, where they're not paid as much, and maybe that's because they lost it at one place and needed to go somewhere else. They're locked in at these mortgage rates or these expenses with these very low savings accounts. And what happens is the minute something breaks, they don't have any money. And, and that could, result in them not having heat or air conditioning in their home. And, and we're seeing these people, especially first-time buyers, jump in. I think first-time buyer millennials was 30-some% of the new home purchases last year in 2019. But we want to look at some of these statistics. So let's go ahead and pop up the first slide. And we're talking, guys, this is current data, the National Association of Realtors. For those of you who listen, we'll explain it to you. This was just posted October 22nd. Existing home sales, and this is nationwide, soared 9.4% to 6.5 million in September. Some key highlights here: existing home sales grew for the fourth consecutive month in September to a seasonally adjusted annual rate of 6.54 million homes, up 9.4% from the prior month and nearly 21% from a year ago. The median existing home price was $311,800, almost 15%, guys, more than September of 2019. That is a huge median existing home price. Matt, tell us, what's that $311,000 house going to cost somebody on average a month?
Well, I mean, there's a lot of factors in there, right? So, 3% down, 5% down, 20% down, but a lot of folks are putting 3 to 5% down, and I don't have a problem with that. But like you said, when they've got nothing behind it, let's call it, with 5% down and good credit and whatnot, let's call it a $1,700 or $1,800 a month payment with mortgage insurance, taxes, and it's going to vary across the nation. We're in two different parts of the country, but I think these stats are interesting. One thing I thought about, Todd, when you look at this and you think to yourself, year over year, if something goes up 15%, it's a $45,000 difference. Part of me says every $10,000 might be $50 or $60 a month in payment. So you could call it a $250 difference in payment, an increase in payment, but I don't have the numbers in front of me. But if you look at September 2019 versus September 2020 on rate, if you take the rates and you're down 3/4, you go from 3.5% to 2.75% on a 30-year fix. These are just wild numbers. I'm not quoting any specific rates. You probably have the same payment. So part of this steroid injection the market has is interest rates. And there's charts out there. This mortgage monitor by Black Knight that talks about forbearance data also has origination data, how many loans are being originated. And you can see as rates go down, mortgage originations go up, not just on refinance because people have more opportunity to refinance, but on purchase because their purchase power increases. And so a big part of it is that, I think.
So, but just kind of, I mean, give me an idea. So a $311,000 house with a, just say average taxes of, $6,000. I mean, we're talking $2,500 a month?
No, I bet you
$2,200 a month.
I bet you it's closer to 1,800 to 2,000.
1,800 a month. Okay.
And what's the average property tax for you out there? Is it 2%?
It varies. Yeah, it varies from county to county, but yeah, about you just figure 2%, sure.
Yeah, because we're 1.25% in most areas of California, so maybe where it's 1,800 for me, it might be 2,100 for you if your taxes are that much more expensive.
And it depends on the county. You know what I mean? It's
right.
Whether it's Howard County, it's higher, and Baltimore City. Baltimore City is very high in taxes. So, what my point is, so maybe about $1,800 a month. So the average person buying a house in the median range here, $311,000, might be $1,800, $2,000 a month. So and that is and that's them putting down a minimum of 3%.
Right. Probably
in most cases, right? I mean, average
5%.
Okay, so they need a lot of cash, right? They're depleting their cash in a lot of situations. You're talking about probably putting down $20,000 in cash. I mean, if we had to crunch numbers, 5%, plus closing costs, things like that. I mean, it's very realistic that they're putting 20 grand down, something like that. And, and again, these are rough numbers, guys. We're just trying to say, the average person, has $5,000 in the bank. I mean, so, what I'm saying here is this is a lot of money for people. That's my point is, achieving these, home buying, dreams for many. I mean, you're going up 15%, year over year from last year to this year in housing prices combined with lack of inventory, not asking for improvements to be done on these houses. People are spending a lot of money. They're liquidating all their cash. in most cases, or a lot of cases, and they don't have any money to fix stuff. So, total housing inventory declined from the prior month over 1 year ago to 1.47 million, enough to last 2.5 months of inventory. It's a record low. And at the current sales price, and more than 7 in 10 homes sold in September, 71% actually were on the market less than a month. So, I mean, these things are going very quick. It's a very stressful time for buyers. And what I'm saying to you guys is, and I hate to say that because we're in the business of selling houses, but I think, you guys need to slow down. I think that, people need to, take a breath. Who knows what's going to happen? I personally believe we're going to have foreclosures on the horizon. But I think that people should really be, mindful as to whether they should be buying right now. Let's talk about some more key insights. Total housing inventory at the end of September totaled 1.47 million units, down 19.2% from a year ago. This is nationwide. Here in Maryland, we're about 50% of the inventory that we had a year ago. Again, unsold inventory, 2.7 months supply. It was 4 months nationwide a year ago. Interesting enough, sales and vacation destination counties have seen a strong acceleration since July, a 34% year-over-year gain in September. I think uncertainty of the pandemic, coupled with the ability for people to work from home, have boosted sales in summer resort regions, including Lake Tahoe, Mid-Atlantic beaches, Rehoboth Beach, Myrtle Beach, the Jersey Shore areas. Properties typically remained on the market for 21 days in September, was an all-time low. Last year, it was 32 days on average in the marketplace. 71% of homes sold in September 2020, like I said, were on the market for less than a month. First-time buyers were responsible for 31% of the sales in September. That's down from 33% in August and a year ago. And interestingly enough, all cash sales accounted for 18% of transactions in September. I think a lot of that is driven by the investor market that's trying to grab as much inventory as they possibly can, to get it market ready to take advantage of these, record high selling prices. So, Matt, we've got about 15 minutes here, man. Let's kind of, chat it up on, what's your gut, man? Are we going to see widespread foreclosures coming in the next 12 to 18 months?
Well, I've seen really good arguments on both sides. Really good arguments for why we're going to see a humongous crash, a humongous correction. I've got a guy who I follow who's a really smart guy who sees 2021 in single family going up 10%. And so I probably lean towards we've got to correct eventually, right? We can't just keep increasing forever. And I'll say real quick, I agree with you on we want to warn people. We want to warn people to say, hey, listen, if you're in a great place where you make $250,000 combined as a household, you both have stable jobs, you've got $165,000 in the bank, and you're going to put $100 down on a home that's a small percentage of your monthly income, you're fine. And real estate as a long-term investment, I've made videos on this and I'll preach this forever. It's a good thing. But the scenario that you pointed out where somebody's buying an entry-level home and they're scraping together every last penny they have, they're getting a gift from their aunt and uncle, they're getting a gift from their parents, they're pulling a 401k loan, and they're going to have $900 after they put 5% down on this $300,000 house. I don't advocate that. I think that is a recipe for pain. And I tell people, as a mortgage broker, I want to be part of your dream. I don't want to be part of the nightmare. And so somebody in that scenario, you've got to be very careful. And you don't want to just, there's an irrational exuberance in the stock market and the real estate market both. And, anybody who denies that, I don't know what they're watching, but it's just, it's irrational. The 15 offers per house and removing all the contingencies, it's crazy. And so with that being said, I think if 1 million of these 3 million forbearances turn into foreclosures, there's so much demand that I almost see that leveling things out for a housing market that needs inventory. A housing market that, like we saw and all the stats showed, there's not enough inventory. We need a glut. And so that can happen. It could level things out, and we stop seeing 9.4% year over year, and we go to zero, and things flatten out. In another extreme case where those 3 million and another million that enter and 4 million foreclosures happen, then we've got, everything is supply and demand to a certain extent. And if there's a lot of supply, a lot of things foreclose, and, now we've got 3, 4, 5 months of inventory, prices will come down. And I tell a lot of people, because I'm working for the buyer, I'm on the buyer side, and as a real estate investor myself, I'd love for things to go on sale. I don't know when it's going to happen, to what extent it's going to happen, but I don't root for anyone's pain or anybody losing their house, but for buyers, something to relieve this inventory issue we have. I mean, in California, we're so far behind in what is needed inventory wise to fulfill the demand that it's hard to predict a time when, especially at the entry level markets, there's going to be enough inventory to fulfill that demand where prices decline in any significant way.
Yeah, so I agree with that. And, as a real estate investor too, I mean, and we serve a lot of real estate investors. I mean, I know people they're wondering, when's the deal? Where are the deals? And, how do we make money? I mean, you have to be very creative. I've been telling everybody, you have to look for properties that, have a higher and better use. You have to look for properties that can be subdivided, to where you can actually, rehab a house and build a house. And that's your upside. I mean, a lot of times, the sad part on the investor side is the margins, you do a lot of work, you have a lot of risk, and the profit margins are very slim. And, if you want to be in that marketplace, you have to operate. There's no more grand slams. And, but as far as, I think the message here if I had to speak to, two individual situations tonight. One would be you're in mortgage forbearance, or you're in a situation where things don't look great. We go in ups and downs through life, and I would say I encourage you to talk to a professional, talk to an agent. Don't wait. Don't wait to the worst case scenario. Don't wait until foreclosure is imminent. Talk to a professional, find out, be aware of what the market is. And though it may not be ideal for you, being someone who has gone through a couple, I've been serving the real estate industry for 30 plus years. And one aspect or another, was a builder, was a contractor, and seeing the effects that it has to go through that losing your home process is devastating. It's devastating for you. It's devastating for your family. If you have children, it's a terrible thing. Consult with somebody and say, hey, look, with this short inventory, do I have options? Can I sell? Can I get out and take a temporary situation change to where you can get back on your feet and get back in the marketplace? And if I had to, give advice to the new buyer, the person the millennial right now, that is the number one biggest buying group right now. If you're listening to this and you're coming out of college or you've been in the workforce, you have to realize that no matter what happens, guys, we are going to see a recession of some type. It has to happen. One of the ways that we know what is happening in the future is we have to take a look back in time in history. And I've done this before. I've gone back a couple hundred years. You can do the same thing with this great website called Google. Take a look at every 10, 12, 15 years. They used to be called panics. Then they were depressions, and then we call them recessions, right? Now we've got pandemics to add to it. Guys, things are going to go up and things are going to go down. If you're thinking about buying right now, slow down a little bit. Don't get caught up in this frenzy. You save your money, live with your parents if you can, or family or friends, or rent if you can, and get yourself in a better position. I personally think there's going to be an adjustment at some level here in the next 12 months. I don't have a crystal ball. I can't guarantee it. But being in this business, I know that the highs and the lows, there are going to be changes. Now, there also may be changes in interest rates, which is the flip side of it. Yes, you're buying at all-time low rates, but you're buying houses at all-time high prices as well, right? 14-year highs to be exact, according to NAR. Matt, what can you speak here in the next couple minutes as to your thoughts on what will happen with the interest rates?
I have told every single person I've talked to who calls me, and they have this same exuberance and excitement, like, oh, I want to do this now because interest rates are so low. Everything that the Fed is doing and everything that's artificially suppressing rates, they're going to continue to do. And if rates went up 3/4 of a point, it would be disastrous for the economy. It would be disastrous in so many ways that the powers that be just won't let that happen. So if I were to guess, I actually just recorded a video that probably won't be on my YouTube page for a couple of weeks, where I predicted mortgage rates for 2021. I think they'll be lower. And the reason why I predicted that is because you've got all these external forces pushing interest rates down. The only floor that these rates currently have is lenders don't have the ability to serve more volume. Every single wholesale lender that I work with is at absolute capacity, and they get to a point where they're like, taking 5 days to underwrite a loan or 8 days to underwrite a loan. They purposely crank their rates up so that demand quells a little bit. And then, another couple wholesale lenders take on more business, then they get too busy and they push interest rates up a little bit. And I've watched it over the last 6 months. There's a lot of margin for these wholesale lenders, and they'd love to squeeze a little bit more on their margins and get more business and lower rates, but they can't. They can't hire people fast enough. UWM, who's in Michigan, who's the biggest wholesale lender in the country, they're hiring 800 to 1,000 people a month, Todd. And once they get to 10,000, 11,000 employees, which they'll have probably by early next year, they can crank it and then go, you know what? We're going to do 30-year fixed in the low twos. Bring it on. And they're already doing 100,000 loans a month. Maybe they'll do 150,000 loans a month. Yeah, and I'll talk to people who are in different situations, and I'll say, hey, you got a 3.75. It sounded real sweet back in 2019, but how about a 2.25? Let's save you $400 a month.
Do you think that people refinancing will slow down them selling and extend the time that they stay in their house? It was 7 years, and it went to 9 years. I mean, do you think that people are refinancing and deciding that they're going to stay there for as long as they possibly can?
Well, it'll affect a certain amount of people. But like me and you talked about in the conversation we had, people do what people do. And I, as someone who has a finance degree, and I love numbers and I love crunching numbers, I'll get into these conversations with people. And then I realize a lot of the American consumers are American consumers. And I'll talk to them about, what you can do by shifting money here and doing this there. And they're just like, I'm going to live my life and I'm going to do what I want to do with my money, And so, so having somebody think about it as, wow, I've got this 2.5% 30-year fixed. If I move and rates are 3.25 4 years from now, I think they're still going to move, honestly. Yeah. So I don't think it'll have that much effect.
Yeah. Well, people, their situations do change, and their needs for housing either expands or contracts, and we definitely go through that in the different phases of life. Well, look, guys, we thank you so much for your time and listening and watching. And we would appreciate, both of us would appreciate, if you're watching us on YouTube or whatever social media channel, go ahead and hit those subscribe buttons and the alert bells, and make sure that you're following us on your favorite social media and audio podcast channel. Matt, thank you so much for your great information and your time this evening. And we'll let everybody get back to the polls. We'll see you next time, guys.
I already voted.
Yeah, I see that, man. Good sticker. Yeah. Good sticker. I did too. I voted yesterday. So whoever wins, man, tomorrow will be a new day and we're going to rock on. So thank you guys. We hope to hear from you soon and see you next week.